Hello and good morning, everyone, to yet another vlog of BVM this time. And yes, I've been listening to a lot of you raising queries about valuation of shares and how difficult it is for you to understand the concepts of valuation of shares. So I have in this vlog tried to create a snapshot of the entire chapter of valuation of shares, which is actually valuation of investments, which includes two things: valuation of shares and valuation of bonds. So I have tried to cover all the important topics and aspects which are there for this particular concept and chapter, and have tried to assimilate all the important concepts which are relevant for December 2018 attempt of yours. So before we start with our chapter, guys, a quick time check. It's already 26th of November. Yes, only 4-5 days left for November. Only 10 days left for December. Please don't panic. Do not. This is the time when students generally face a lot of pressure, a lot of challenges, a lot of pressure to perform, and they are not able to concentrate on studies. They are not able to remember the things which are done in past. Their revisions are not going well. Nonetheless, go on. Do not take the stupid decision of either leaving the attempt or leaving a group. Trust me, whatever preparation you are with currently, go for it, go for the exams, and just remember one thing, that revision is the key to performance in the examination. So you have to revise your syllabus properly during these last days to achieve good marks in your exams. So with this note, let's start with the chapter valuation of investments, and I have prepared some summary notes so that I don't waste time in this video in writing the notes, and you have this readily available with you. So the chapter is divided into basically three parts. Part number 1 is valuation of carrying cost of investments. Part number 2, valuation of investments. Part number 3, preference of methods while valuing small lot and purchasing a big lot. So these are the three aspects which I am going to cover in this entire video. So aspect number 1 is, how should we value the carrying amount of an investment in our balance sheet? So suppose you already have purchased an investment, be it shares, be it bonds. How should you carry that particular asset in your balance sheet? What should be the carrying amount of that particular asset? So I divide investments into two parts. One, current investments. Second, non-current investments. We are primarily dealing with securities in these two parts. Current investments are those investments which you are expecting to realize or dilute within 1 year time span. And non-current investments are those investments which you are planning to keep for a longer period of time with you. So current investments are valued at a lower of. Please note that the limit is that you value the current investment at a lower threshold of cost or market value. So cost is nothing but the purchase price, and market value is the fair value which is there in market as on date. So you will value your current investments using this formula, lower of cost or market value. However, in case of non-current assets, the assets which you are planning to keep for more than a year, those assets are to be valued at cost. Yes, market value is irrelevant for those particular assets. However, you have to deduct from the cost any permanent diminution in value of the asset. So if the value of the assets have declined, and that decline is a permanent decline, which means that you know that market value of this particular asset has reduced, and this is not a temporary reduction, it's a permanent reduction. So I hope you understand the concept of primary movement and secondary movement in the stock exchange. So if the stock exchange moves due to rumors, due to some fake news in the market, then that is known as temporary movement. And if the stock exchange moves on the basis of some concrete information, then that is known as permanent diminution or permanent reduction or increase in stock market. So if your reduction, we are talking about diminution, we are not talking about the increase. So increase in value of cost of assets are not to be considered, only diminution is to be considered. So if the diminution is permanent, then you will reduce the cost of the asset by that diminution. And if the reduction is temporary, you are not going to reduce the amount of cost by that diminution. So this is the principle of valuation of securities, which primarily includes shares. Carrying amount. Next is carrying amount of value of bonds. What are bonds? Bonds are fixed interest instruments which give you a fixed amount of return at the year end, which is the interest. And the bonds are to be valued at carried at issued price or purchase price. So the value at which you have purchased these bonds, that should be the carrying amount of this particular bond, less amortization of premium over the life of the bond. Guys, if you have paid some premium on the purchase price of a particular bond, then that premium is to be amortized over the life of the bond. So this is the principle which you will follow while carrying your bonds to your balance sheet. So let us quickly do one small question, and I'm not going to prepare the proper format, and I'm just going to discuss the answer with you very, very quickly. So I'm at illustration number 32, which is at page number 8.20 of your notes. 8.20, illustration number 32. Futuristic Limited has the following portfolio of investments as on 31st March 2015, rupees in lakhs. There are non-current investments, there are current investments. All right. So tell me, what is the principle of valuing non-current investments? The principle of valuing non-current investment is that it is valued at cost less permanent reduction in price, and current investments are valued at a lower of cost and market value. So let us first see how will these four current investments be valued in our balance sheet. So let's start with shares of XYZ Limited. Guys, shares of XYZ Limited are valued at 250 rupees. They're purchased at 250 rupees. However, market value is 260 rupees. Tell me, what should be the carrying amount of these shares? Lower of purchase value or market price. So they should be valued at rupees 250 lakhs. Second, shares of ABC Limited, they are purchased at rupees 890. They were valued at in the market at rupees 820. So what is the value which they should be carried in our balance sheet? It should be lower of purchase price and market value, which is 820. Next, units of money market mutual fund. There are mutual funds which are money market mutual funds. Again, they are purchased at rupees 15, but their market price is rupees 12, so they'll be valued at lower of the two. Lower is rupees 12. Next is units of growth fund. Now remember, whenever there is a growth fund, it means its majority investments are in equity. So this should be valued at lower of purchase price and market value. Again, rupees 22 lakhs should be valued in our balance sheet. So the value of our current investments in the balance sheet will be 250 lakhs plus 820 lakhs plus 12 lakhs plus 22 lakhs. This is the principle while valuing current investment, which is lower of purchase price or market value. Now coming on to non-current investment. This is a little technical because this involves some judgment, and let us read one information which is given in the question. You are required to compute the value of investment for the balance sheet purpose, which means you have to value it at carrying cost, assuming that fall in value of investment Y Limited. So this fall is temporary fall. Question gives you that this fall is temporary fall, and that of Z Limited. So Z Limited is also falling. Yes, Z Limited is also falling. Fall in Z Limited is a permanent fall. So you have to distinguish between the temporary fall and the permanent fall. So let's see. Let's start with bonds. 10 years bonds, 10% bonds. Current market yield is 9%. 1160 is the purchase price, and market price is 1064. One information is missing in this question, that the bonds are of the face value of rupees 1000. Now the bond should be valued at the cost, of course, and less the amortized value of premium on sale on purchase of these bonds. So this bond is worth 1000 rupees. You have paid a premium of 160 rupees to purchase these bonds. So now how should these bonds be valued? So bonds should be valued at cost less amortization of premium. Now guys, how would the premium be amortized? Please tell me, what is the amount of premium? Amount of premium is 160 lakhs. This should be divided by 10 years because it will be amortized over the period of the bonds. Period of bond is 10 years, so the amortization value comes out to be 16. So the value of bonds which should be carried to the balance sheet is 1144. Okay, sir, got it. Next, shares of X Limited. Shares of X Limited were purchased at rupees 10, increased at rupees 80. Market price is increased at rupees 80. Guys, please remember, we have the provision of marking down the cost if the reduction is permanent in nature, but we have no provision to mark up the cost. So marking up is not permitted. Hence, rupees 10 lakhs should be the value, carrying amount of value of X Limited shares. Now shares of Y Limited. Shares of Y Limited, the fall is temporary. Hence we will not consider the fall. Hence the carrying amount should be 100. Next, Z Limited. Shares of Z Limited, there is a permanent fall. If there is a permanent fall, then we will consider the market price as the carrying value of Z Limited shares. Coming on to shares of A Limited. A Limited shares are valued at 120 and they are reduced to 110. Now the question is silent whether this reduction is permanent in nature or temporary in nature. We will assume this to be temporary in nature. We will write a note to this effect that the reduction in value of shares of A Limited is temporary in nature, and hence we will value the shares at rupees 120. Last, shares of B Limited, they were purchased at rupees 350, increased to 500. As I have stated earlier, increase is not taken into account while computing the carrying cost, and hence the value of the shares of B Limited appearing in the balance sheet should be 350 lakhs. So this is how you have to solve the problem of carrying cost of investments. Carrying cost is different from valuation. Carrying cost determines only the price of the value, actually the amount of the investments which you will be writing in your balance sheet in the future years, and these deals with the investments which you have already purchased in past. So now coming on to the second aspect of this chapter, valuation of shares. Now when you are purchasing some shares and you have not purchased, so we were discussed in carrying value, we have discussed the shares or the bonds which you have already purchased. Now we will discuss the valuation of an investment or a share which you are yet to purchase in future. So value of share, I'll give you a very simple formula to start with. The basic formula of valuation of shares is that we divide dividends by the rate of return or the cost of capital. So dividend which you are going to earn in future divided by cost of capital is the simple capitalization formula of valuation of shares. Now what does this formula attempt to do? This formula is actually discounting your dividend yield for an infinite time period of future. So if you get this dividend from this share for an infinite time period, then what should be value of the share? So this formula represents the discounting which is done for infinite tenure. So dividend divided by cost of equity or cost of capital is the formula, basic formula of valuation of shares. Now this formula is modulated a bit if there is a growth situation. So if you expect the dividends or the value of the company to grow in future, then you use the formula as dividend which is after 1 year. So in this case, dividend will remain same year after year after year. But in this case, the dividend will change after 1 year. So dividend 1 is to be taken. Now dividend 1 can also be written as dividend 0 into 1 plus growth rate. So if you add growth rate to existing dividend, then it will yield dividend of year 1, which means 1 year hence. The dividend which is there 1 year hence. And then you will divide it by KE minus G. Now the challenge with most of the questions, most of the students struggle with is that, so why is growth reduced in cost of capital? Guys, please note that whenever there is growth, then there are synergy benefits, then there are economies of large scale production, and hence the per unit cost of production reduces. So to give you a very simple example, if you take a loan of say 1 crore rupees, then the interest rate which bank might charge you is 14%. However, if you take a loan of 100 crore rupees, then the bank will certainly give you a discount and it will issue the loan to you at a discounted interest rate of say 12%. So if you grow in size, then your cost will reduce. So in the numerator, the growth is added, and in the denominator, the growth is reduced. This is the logic behind reducing growth in the denominator. Now there is a formula of growth. How to compute growth? Formula is return on equity multiplied by the retention ratio. So growth happens whenever you retain your profits and reinvest in them in your business. Reinvestment will yield you the return of equity, and hence the formula of growth is retention ratio, whatever you have retained in your business, multiplied by the return on equity. So this is the formula of growth. Now coming on to the methods of valuation of shares which are there in your syllabus. Guys, there are multiple methods of valuation of shares, but the prime ones which are there in your syllabus and from which examiner asks questions in the exam of CMA final paper number 20 are listed in front of you. Just give a close look to all these formulas. All right. So these are the five methods which are prescribed by your institute's module and your syllabus for valuation of shares. The formulas are NAV, net assets value method, dividend yield method, PE multiple method, earnings capitalization method, discounted cash flow method. These are the formulas which are, methods which are relevant for your valuation of shares. Now, if I, on the basis of importance, if I categorize these methods, then NAV is the most important method, because maximum questions which are practical questions in the examination are asked from this method. Rarely the examiner asks questions of valuation of shares from other methods. So the most important method for your exam is the NAV, or the net assets value method. Again, obviously you have to study dividends yield, PE multiple, earnings capitalization and discounting cash flow as well, but more attention should be given to NAV method. Now let us come on to the NAV method. So what is the NAV method? Simple. You have done it several times before. It is simple method, and it is the formula is really simple. Method is all assets which are there in your balance sheet. One thing to be kept in mind, excluding fictitious assets. So if you have any fictitious assets in your balance sheet, like miscellaneous expenditure, like discount on issue of debentures, if you have any if you have any fictitious assets in your assets, they should be excluded, and all assets minus outside liabilities. So all liabilities which are outside liabilities are to be reduced, because we are actually valuing the equity shares of the company. Hence all outside liabilities should be deducted from the assets, and then the entire numerator is to be divided by number of shares. Again, the number of shares means equity shares. So this is the formula of net assets value method of valuation of shares. Now obviously, if this is the method which comes in the examination very frequently, it cannot be that simple. Institute is not going to give you marks. Please realize you are in CMA final. Institute has to ask you some questions which are technically of superior quality, and hence institute never asks this question independently. It always amalgamates a question on goodwill along with NAV. So what happens is, in a question of NAV, you have to first compute the goodwill and then you have to compute the NAV. So the note says goodwill to be recomputed as per the super profit method. So there's a method in computation of goodwill, super profit method. Goodwill is to be recomputed as per the super profit method if details are given in the question, and that recomputed goodwill should be added to all assets, and then NAV is to be computed. So now you will get the loop. The loop is that the question will first require you to compute the goodwill. You have to then add that goodwill to the assets value, and then after adding that goodwill to the assets value, you will be able to compute the value of shares. So now coming on to computation of goodwill, which is again helpful for your goodwill chapter as well as shares chapter. So I hope you have already done the goodwill chapter. So it will be a quick revision for you, those who have done the goodwill chapter. And if you have not done the goodwill chapter, then this will be a summary of goodwill chapter for you. So I'm discussing computation of goodwill as per the super profit method. Super profit method, as we all know, is the differential of future maintainable profits and normal profits. So future maintainable profits which your company is going to earn in future is known as future maintainable profit. If you reduce normal profit means a profit which a normal company in your industry will earn as per the normal rate of return which is existing in the market. So this is what you earn. This is what a normal company earn. If there is a positive difference between these two, it will represent goodwill of your firm. And the positive difference between these two is known as the super profit. This is known as the super profit. And then you multiply this super profit with number of years purchased to compute the goodwill. Now, sir, please tell us what is future maintainable profit. So future maintainable profit is the current profit which you have earned just now, or it can also be an average of past year's profit. You have earned, the data is given to you for past 4 years or 5 years. Then you have to take average of those past 5 years or 4 years profit, which will represent the capacity of your earning in future as well. So you will take the current profits. You will adjust, first of all, you will adjust for any errors. If there are any errors, then you will rectify those errors. This step is known as rectification of errors. And then you will adjust any future expenses which you expect, or any future income which you expect, then you will adjust that. So two adjustments are required in current profits. One, the rectifications. If there is any error in the existing profit, then you have to rectify that profit. And second is the adjustment for any future expenses. If there are some expenses which are expected in future, then those should be adjusted to compute FMP, or known as future maintainable profits. Now coming on to normal profit. Sir, what is normal profit? Normal profit is the capital employed which you have employed in your business, and the normal rate of return which any person in the industry would earn on this capital employed. So I'll give you an example. If you have a capital employed of 1 crore rupees, then a normal person of your industry will earn 10% of income. Now 1 crore, 10% is 10 lakhs of income. So 1 crore which you have employed, 10%, 10 lakhs of income. This is normal profit. Now suppose if you are actually earning 12 lakhs of income, then that will be future maintainable profits. So difference between 12 lakhs and 10 lakhs, this difference will be super profit. And why would this difference be there? This difference will be there because of existence of some intangibles which we term as goodwill. So normal profit is nothing but a multiplication factor of capital employed with normal rate of return. Normal rate of return is usually given in the question, and you have to compute the capital employed. So now the biggest challenge or the biggest problem which students face in this entire chapter is, sir, how to distinguish whether to choose closing capital employed or average capital employed. This is the question which revolves in your mind day and night. So before coming on to this question, let me tell you what is closing capital employed and what is average capital employed. So closing capital employed is the net worth or net assets at the balance sheet closing date, and average capital employed is opening capital employed plus closing capital employed divided by 2. So closing capital employed is the capital employed which is existing at the closing balance sheet date, and average capital employed is the capital employed which is opening plus closing divided by 2. Now to take a simple example, suppose opening capital employed is 100, closing capital employed is 150, addition during the year is 50. I have asked you to compute the average capital employed. You know that closing capital employed is 150. What is the average capital employed? You will tell me, sir, 100 plus 50 divided by 2. 250 divided by 2, which is 125. Now I'll also tell you a shortcut method of computing average capital employed if you are not given the opening capital employed. So if question doesn't give you opening capital employed, how will you calculate average capital employed? You will calculate average capital employed by taking the closing capital employed minus half of the additions. See, the answer is same? Yes. So this is the second method, which is closing capital employed minus half of the additions. I'll give you another formula of computing average capital employed, which is opening capital employed plus half of the additions. This will again give you the same result. So this is the third formula of computing average capital employed, which is opening plus half of the additions. So depending upon what information is given to you by the question, what is supplied to you, you can choose either of the three methods while computing average capital employed. And I'll tell you a funda that while calculating average capital employed, we take opening capital employed as 100% weight and we give 50% weight to the additions, because we assume that additions have taken place exactly during middle of the period, exactly after 6 months. So we take the weight of additions as 50% and hence we always add half of 50 to 100 while computing average capital employed. Yes, sir, this is basic. So now coming on to the question which you guys struggle with, sir, which capital employed to choose, opening, closing, average, depending upon question, we are not able to understand which one to choose. Let me start by saying that there is no statutory provision or there is no statutory requirement to choose one method over the other. There is no statutory requirement of choosing any method. Of course, average method is always better because it averages out the entire capital employed within the entire period. So you can either choose average or closing. Nothing is wrong, nothing is right, but I have given certain pointers which can help you think which one is better in which situation. So if you are given in the question both opening and closing balance sheet, then the question is hinting you to choose average capital employed. Now if only closing balance sheet is given to you and only last year's profit is given to you, the earlier year's profit is not given to you, only closing balance sheet is given and last year's profit is given, then you should choose average capital employed. Third situation is when only closing balance sheet is given to you and last year's profit is not given. So you have been given profits of say years before the last, but the last year's profit is not given. Students, if last year's profit is not given, then you will not be able to add half of the last year's profit, and hence in this situation closing capital employed is to be computed. Then last situation is when only closing balance sheet is given and past many years profit are given. So including the last year, you have been given profits of past many years, say 3, 4, 5 years of past is given including the last year's profit. Then you have to see whether the FMP which you have computed, future maintainable profit, is computed on the basis of weighted average profits. So weighted average is computed only when there is trend in past profits. If you have computed FMP on the basis of weighted average profit, then you mostly choose closing capital employed. And when FMP is computed on the basis of simple average profit, then you mostly choose average capital employed. So these are just a guidance on how to choose the appropriate method of capital employed. However, I repeat that there is nothing wrong or right while choosing average or closing capital employed. So even if you are confused in your exam whether to choose closing or average capital employed, please give a note that the normal profit is computed on the basis of whatever you have taken, average or closing capital employed, and hopefully you will not have any deductions in your marks. So this was the method of super profit, calculation of goodwill, and NAV we have already discussed. NAV, we have to insert the value of goodwill in NAV and then compute the NAV. Now coming on to the four methods which are relatively easy and which are relatively less important than NAV method. Method number one is dividend yield method. The formula is actual dividend yield divided by industry dividend yield multiplied by face value of the shares. Guys, let me tell you, this method is nothing new. This is the same toffee being given to you in a different wrapper. Sir, what do you mean by that? What I mean is that you remember we have done the basic formula of valuation of shares. The basic formula was dividend in rupees divided by the expected rate of return or cost of capital. We had done this basic formula. This dividend yield method is similar to the basic formula. If I multiply the numerators, actual dividend yield multiplied by face value of shares, I will get the dividend amount. And the industry dividend yield is nothing but the KE, which is the expected rate of return or cost of capital. And hence I say that the dividend yield formula is similar to the basic formula which we have already discussed. So this is the dividends yield method. Next is the P multiple method. Very easy method. We have been doing it since our inter. So what is PE? PE is market price per share divided by earnings per share. So if you want to compute market price per share, then you will multiply PE with EPS. This is exactly the same formula. Value of share is equal to EPS multiplied by the PE ratio. Simple. Next, earnings capitalization method. Now here what we are doing is we are capitalizing the earnings. First, earlier we were capitalizing the dividends. You remember the basic formula? We were capitalizing the dividends. In earnings capitalization method, we will capitalize the earnings. But please note that we will take the future maintainable profits after tax as our earnings. Whole divided by K. This will give you value of the entire shares. And then what we'll do is we'll divide it by number of shares to get the value per share of a particular company. Please remember, if this company has debt capital, then before dividing the number of shares, you will reduce debt capital from this total value to compute the value of only equity shares, because we are computing the value of only equity shares. Then last but not at all the least, and one of the most popular methods, discounted cash flow method. In the discounted cash flow method, we just find the present value of future cash inflows. There are future cash inflows which are occurring to us, which will occur to us in future. We will have the present value of future cash inflows. You would remember the formula which we use for finding the discounting factor. 1 divided by 1 plus R, rate of return. So if it's 10%, then it will be 1 plus 10% whole raised to the power. If the earning is for 5 years, then we'll raise it to the power of 5. And this is the present value of future cash flow method. Guys, these methods are relatively less important than the NAV method. You should undoubtedly do the NAV method with full force and solve all the practical questions which are given in the module for NAV method. Now, one very important topic which sometimes comes in the examination is preference of choice of method in certain situation. So we have done 5 methods till date. I'll tell you 2 situations where I will prefer one method over the other. Although there is no preference as such, but certain situations demand certain methods to be given priority as compared to other methods. So the situation is, there are 2 situations. Situation number 1 is when small lot of shares is to be acquired. So when you are acquiring only small lot of share, I mean from 100% of the company's shares, suppose you are buying only 5% or 10% or 15%. That is known as small lot of shares. If you are buying only a small lot of shares, then guys, let me tell you, your objective or your prerogative is dividends of the company, and hence the method to be used is dividends yield method. Dividends yield method. But if you are acquiring controlling interest in a company, which means you are acquiring 50% or more shares in a company, then your objective is not only dividends, but also the growth in the value of the share, the earnings which the company will give you. All these three things are important, are in your mind when you are buying the controlling interest of a company. Under this circumstance, the method you have to choose is fair value method. Sir, but you have not done fair value method. We have not done fair value method. Relax, students. Fair value method is nothing but an average of NAV and earnings capitalization method. We have discussed the NAV method. We have discussed the earnings capitalization method. If you take an average of these two methods, then that gives you the fair value. There is another formula for fair value. This is option 1. This is option 2. Option 2 is only take earnings capitalization method and don't take NAV. But please note that option 2 should be chosen only when details related to NAV is not given in the question. So we have to always choose option 1 if option 1 is given in the question. If NAV is given in the question, details related to NAV. If details related to NAV is not given in the question, then we will choose earnings capitalization method. So this is a brief snapshot of all the formulas, all the concepts which are there in valuation of shares chapter. Now guys, the responsibility which you have is to complete all the questions which are given in the module, scanner, my notes, anywhere, wherever you can find the questions from. And you know yourself that a question from equity shares is bound to come in the examination. And equity shares has two aspects. One is the valuation of goodwill aspect and another is the valuation of shares aspect. So this chapter is very, very important. Please do this chapter very carefully and very precisely. So let me tell you, let me give you some hints on which chapters are important from BVM. Mergers and acquisition, very, very important. Human resource accounting, very important. Brands, very important. And valuation of shares, which is bonds and shares, very, very important. So these 4 chapters are very important and questions come repeatedly from these 4 chapters. So I've covered this chapter, and yes, I am on to my objective of preparing the cost accounting standards series, and I'll be releasing the videos soon on the rest of the cost accounting standards. Till that time, please study well and don't panic. Guys, don't become nervous. Have faith in God and have faith in blessings of your parents. Don't worry, even if you are slightly nervous or slightly less prepared, that's okay, that's perfectly fine, because the students who are giving examination, none of them are 100% prepared. So you are sailing in the same boat. So don't worry, you will definitely pass in the December 2018 attempt and will pass with flying colors. So happy studying.